Having introduced Ricardo's concept of comparative advantage, it's probably helpful to take it a step further and talk about why countries might have comparative advantage relative to other countries, or how those trade patterns might play themselves out. And that's where we get the Heckscher-Ohlin model, which I'd like to introduce now. So the Heckscher-Ohlin model sort of helps to explain one of the, I don't want to say puzzles, maybe I'll go with quirks in Ricardo's example about Portugal and England being able to produce wine and cloth at different rates, because it's not exactly clear from Ricardo's sort of scenario why one country would be better positioned to produce cloth or to produce wine than others. And ideally, you would want to know that so that you could identify what kind of countries you would want to partner with in terms of trade to find that comparative advantage and that maximum efficiency. And the Heckscher-Ohlin model helps us to kind of get at that by thinking about countries and how their economies work in terms of two different components of production: labor and capital. Capital being cash, but also machines, basically the stuff that goes into production. And different goods are going to require a different mix of labor and capital. And so, piggybacking on Ricardo's example, if you're trying to make wine is a very labor-intensive process because you have to pick the grapes and you have to stomp the grapes or press the grapes, and then you age them in bottles, but most of the work is done through labor. Whereas cloth production is going to be very capital intensive, right? So once the sheep have been sheared, you have to spin the wool into thread, and you have to weave the thread into cloth, which requires looms. And so there's lots of machinery that's going to go into cloth production, which means that countries that are going to have more capital are maybe going to be better positioned to produce cloth than countries that are labor abundant, which are maybe going to have a better opportunity to produce wine. So this is kind of extending that idea to explain why we would see different patterns between countries. And so that might help account for why we would see England specializing in cloth production because they're capital abundant, and why Portugal might specialize in wine production because they're labor abundant. But it also has these implications for what we should expect to see in terms of patterns of trade and economic activity. And so one implication is that capital intensive states, wealthy states with deep capital markets, should trade most with states that are relatively capital poor and labor rich, because those countries are going to, those combinations are going to have the maximum comparative advantage and gains in terms of reducing opportunity costs. Another implication is that if you are a worker in a capital rich state, there's just not as much demand for your labor because there's opportunities to replace labor with machines. And the industries that are successful in capital-rich economies are going to be industries in which there are lots of machines and not a lot of workers. Likewise, if you are a capitalist and you have lots of money to invest, but you are in a labor-rich state, there's not going to be deep capital markets within your country, whether that's stock markets or bond markets. Even the banking infrastructure may be underdeveloped. And there just aren't going to be a lot of businesses that are operating in companies that are looking to acquire lots more machinery because what they're producing is primarily labor intensive. And so there just aren't investment opportunities in labor rich economies in the way that you would expect, to the extent that there are in capital rich economies. So again, just trying to extend that logic out to try to get a sense of what we might see, and then we can kind of test to see if those things are actually supported. And the record is a little mixed. When we think about trade patterns, the idea that wealthy countries are most likely to trade with poor countries isn't borne out quite as strongly, or maybe even at all, the way we might expect given the logic of comparative advantage. This is a map just of U.S. trade patterns, and you'll note that the United States trades a lot with China. Certainly it imports a lot of stuff from China. And when people talk about why that is, it's oftentimes because China has much lower labor prices, and so goods coming from China are much cheaper. And that's certainly true, and that certainly is consistent with the Heckscher-Ohlin model. But the United States also trades significantly with Canada, almost to the extent that the United States trades with China. And then when you throw in Mexico as well, the United States is trading much more with other countries than with China, where Heckscher and Ohlin would say there's the greatest likelihood of a comparative advantage. So we're seeing a lot more trade between countries of similar economies in terms of development, in terms of capital intensiveness, than we would probably expect. But some of the other implications do seem to have some support. And so if you are a worker in a capital-rich state, oftentimes you're going to be investing in skills to try to make yourself more efficient. Workers in capital-rich states are trying to outcompete machines. They're trying to demonstrate that they can bring value to jobs above and beyond what you can get by just simply adding another machine into the mix. In capital-rich states, people invest in higher education. They invest in skills acquisition. That's a major part of worker preparation. In capital-poor states, we also see support for the Heckscher-Ohlin model, and that if we look at global patterns of investment, more money flows from poor countries to rich countries in terms of investment than goes from rich countries to poor countries. That people who have cash in poor countries tend to take that cash and invest it in the capital markets of wealthy countries, which fits with the Heckscher-Ohlin model about where there should be demand. But when we turn back to that question about trade, which was really the core question that sort of animated this whole discussion to begin with, it's worth thinking about why we see so much inefficient trade between economies that have similar mixes of labor and capital rather than highly divergent mixes of labor and capital that would produce greater savings or benefits in terms of comparative advantage. And economists and political scientists tend to differ in terms of how we explain this. And so if economists are trying to explain this, they might say, well, it's geography and shipping costs makes certain trading patterns and certain trading relationships more beneficial. I'm not 100% sure that that's the case. Shipping costs are incredibly low. It's to the point where, I'm here in the center of, the United States in North Dakota, and poultry that are being raised in this part of the country get slaughtered, put on ships, frozen, shipped to China, processed, shipped back to my local supermarket, because shipping costs are just so ridiculously cheap compared to labor costs. And so economists would then pivot maybe to talking about what the Linder hypothesis that says that states produce goods or companies produce goods that reflect the preferences of their particular market. And countries with similar mixes of labor and capital are going to understand the markets that they're exporting to. That's a really abstract way of thinking about this. So when I was in China for a number of years ago, with my son, we played a game called Capital Rich, Labor Rich, in which we just pointed out differences in terms of how things ran that reflected different distributions of capital and labor, right? And so the street sweeping that was done in where I live, Grand Forks, North Dakota, was done with a great big honking machine. And the street sweeping that was being done in China was being done by individuals with brooms, right? Labor rich, capital poor. But there were other things about China that really struck me as sort of strange. So one of the things that drove me bonkers is that I couldn't get a Kleenex or a napkin that really would hold up, that napkins were rare, and the Kleenexes I would get were just this flimsy sort of thing, and contrasted really starkly with the Kleenexes I can get at my local grocery store, which are triple ply, they're quilted, they're lotion infused, and the box that they come in is this decorative designer thing, right? There's a lot of investment in a tissue that's just not happening in China. And the Linder hypothesis would say, and that's why you trade with countries that have similar mixes of labor and capital, because a company in China thinking about breaking into the Kleenex market in the United States isn't going to think about triple ply quilted lotion infused Kleenexes, but a German company trying to break into the Kleenex market in the United States will be thinking about that, and will be thinking about what German consumers really like that American consumers don't even know that they desire yet in a Kleenex. Okay, so that's the Linder hypothesis. Political scientists approach this a slightly different way. So there's international explanations and domestic explanations for why we see these patterns. And so the domestic explanation is that workers in rich countries correctly intuit that trade agreements with poor countries are going to mean that they're put in direct competition with workers in poor countries. And they fear that they're going to lose out, that these trade agreements are going to reduce demand for labor, and that this is going to be bad for workers in rich countries. And so they push back and they block trade agreements with countries that are significantly poor, that have lower labor costs, that are labor rich. Whereas trade agreements with countries that are of comparable capital labor distributions, workers will say, you know what, I can outcompete or be competitive with workers in Germany, or workers in Canada, or workers in the United Kingdom, and therefore I'm not feeling the need to block those trade agreements. If they're beneficial, great, we'll do that. So it may be a function of how much efficient trade is mobilizing domestic pushback. Alternatively, we could look at why trade agreements are set up and note that trade agreements are not set up to be economically efficient, that trade agreements link economies together, and states are making conscious choices about where they want to link their economies and who they want to link their economies to. And oftentimes trade agreements are reinforcing or expanding existing relationships between states, connecting allies, further strengthening those partnerships. And those relationships don't have to be economically efficient to make sense in terms of whether or not you create international treaties to support them. So as we're thinking about global patterns of trade, I think it's, again, and this is sort of the core insight of international political economy, it's important to understand the economic efficiency aspects of it. It's important to understand the trade theory, but the global economy exists within a political context, and that political context oftentimes gets mapped into how things operate and what is deemed maybe not efficient, but politically expedient or feasible or not objectionable by actors with the power to block, promote, or advance different economic outcomes.